And again, we want to thank you for being on the call today with Monica Rebella, CPA and President of Rebella Accountancy, which is a CPA firm that specializes in small business accounting, tax, and consulting for several hundreds of small businesses and dentists in California. Topic of the call today is year-end tax planning for 2013 and how to fund college costs for children. If you're not already a current client of Rebella Accountancy, or if you've not met her, Monica Rebella is a CPA. She has 25-plus years of accounting and tax experience, which includes 13 years working with the Big Four, Big Eight firms, and over 12 years experience working with small businesses and dental practices. She is past president of the Orange County Long Beach chapter of the California Society of CPAs and is a member of the AICPA. Monica has also conducted training sessions for accounting firms, as well as lectured on tax and business matters to the California Society of CPAs, UCLA Dental School, and the Orange County Dental Academy. She runs her own firm in Tustin, California, providing tax, accounting, and consulting services for over 300 businesses throughout California, specializing in small businesses and dental offices. Monica, good afternoon or good evening, and welcome to the call.
Thank you so much, Jeff. Nice introduction. Appreciate it. And welcome, everyone, especially just a couple days before Thanksgiving. Take time in your evening to be with us. So let's get started, because here we are, November the 26th. We are so close to December 31, running out of time. So we're trying to maximize what you still might be able to do here. So my first slide is 2013 year-end planning. Issues coming at different income levels. And the reason I'm starting with this is I'm going to lay some groundwork here. We've got a whole new set of tax laws beginning 2013 because of the Affordable Care Act, which is AKA Obamacare. In addition to that, we had a January 1st tax law change when the President and Congress got back in. They put in a law on January 1st that affects things that are changing for 2013 going forward as well. So what I want to do is let you know that some people aren't even worried about or need to be worried about these changes, and that's the income of $200,000 if you're single or $250,000 if you're married. If you're under those thresholds, everything is as usual. Do your year-end planning as usual, okay, which is mostly have a lot of expenses in December, defer your income into 2014. It's a constant deferral. If 2014 is going to be a higher tax rate year for you, for instance, if some of my clients are looking to sell their businesses, okay, let's make sure we put income into 2013 because we're already going to have a high year in 2014. So we want to look at those things here at the end of the year. If you're at $400,000 if you're single or $450,000 if you're married, yes, some of the new tax law changes are going to affect you, but at least you have not hit the new tax law rate increases. Once you've gone over these two amounts, you are now at 39.6% tax rate on every dollar over those amounts. And there's some other crazy things that happen as well, and we'll talk about that as we go. So I wanted to start with some of these thresholds where you're pretty good. The next is this new Medicare surtax. And remember, the Supreme Court decided that the Affordable Care Act, these monies that they're trying to gather here, for not having insurance as a tax, well, not only that is there's a Medicare surtax that's in here. So the first one is net investment income Medicare surtax. This is a tax on interest, dividends. Unless the dividends are tax-exempt interest on bonds, they're going to be certainly included as interest. Dividends, capital gains, and when I say capital gains, I mean gains, so it's after your losses. And a lot of people have said, well, if I sell my house, does that get included there? It does if you go over the $250,000 exemption for each person. So if you're married, you got a $500,000 gain you don't have to pay tax on. So it would be over those amounts, but it'd be gains on stocks and other things. Rent, okay, we're going to talk a little bit more about rent, but if you have rental property, rent's going to be in this calculation. Your income has to go over $200,000 if you're single first before this applies, or $250,000 if you're married, okay? So the biggest thing here is, can you or do you want to change some of your interest to bond tax-exempt interest? A lot of issues around that because the return's not great. A lot of people are talking about getting out of it, including PIMCO. PIMCO is the biggest bond holder in the country, and they are changing their minds about some of the bonds. So a lot of issues about whether you want to do that or not. There's also the ability to offset gains with losses. So if you've got some losses in the stock market and gains, we want to net those to kind of be gain neutral. So you want to look at that. There is another level of this net investment income Medicare surcharge tax, and it's a 0.9%, so that would be 0.009 on your income that exceeds these total amounts. So it would be income $200,000 if you're single, over $250,000 if you're married. So the biggest thing here is if you're getting close to these, watch your December income, because you probably don't want to exceed these for many reasons. If you also exceed these amounts, your payroll taxes go up. This is how they're trying to get this 0.9% additional tax, is through payroll. So you want to watch these things. And it's not so bad as it seems, because actually we get to use some of the itemized deductions to reduce these thresholds before these taxes take effect. So let's go to an example. So my example here, a married couple, they've got $390,000 of total income. Included in that $390,000 is $20,000 of interest and dividends. Okay, well, we know they're married. They went over $250,000, so boom, they're already into both of the Medicare surcharge taxes. So the first one is that they're going to get hit with a 3.8%. I'm sorry, we're going to start with the 0.09 on the fact that they went over 250. So they went over 250 by 140. We take the 140 and you simply multiply it by 0.009, which is $12.60. Okay, so that's the additional tax. You're going to pay it if you're at this level. The next is a little more complicated. We look at the lower of what's the total of interest, dividends, rents, gains, etc. And then we look at how much did you go over 250, and it's the lesser of. So in this case, their interest and dividends, that's all they have, is $20,000. So it's just the $20,000 times the 3.8%, which is $760, okay? Those are the two. New tax, just going to be what it is. And you can see on the next slide, the tax is $2,020. Good news is that that's really not the end of it. Then we go in to look at state income taxes that you've paid, investment interest expense, investment fees, and we actually get to reduce those dollar amounts before we apply the taxes by some of these based upon a percentage of various things. So it's not quite even that high. So for most people, it's going to be additional tax. We don't like paying additional tax, but it is a manageable one. Okay? All right, so our next slide. There is a new top tax rate, and this was the January 1st change that came in, is that everyone that makes $400,000, over $400,000 that's single, you make more than $450,000 if you're married, every dollar over that is going to get hit at 39.6% tax rates. Ouch. Because in California, if you're at those rates, you're going to pay tax at 9.3. So just add another 10, right? Just add another 10 right there. So now you're at 49. You are hitting 50% tax rates, my friends. You're at 50% tax rates. That is huge, okay? So you want to watch your income and expenses. If you're getting close to these things, you got to watch what's going on in December and now. Additionally, if you hit these thresholds, you're at 20% capital gains rate for the feds. California doesn't have one. It's just whatever the rate is. So federal capital gains rates at 20% if you go over those rates. Okay? Again, we might want to push something into 2014 if in 2013 you're getting very close. Again, it's year-end cutoff. What do we want to do? All right, let's go to our next slide. So the next slide is itemized deductions. So here's another part of the January tax law change. So beginning 2013, once your income hits $300,000, you're starting to lose your mortgage interest, your real estate taxes, your charitable contributions, etc. It starts at 3% of the amount over the $300,000. When you get to $450,000, you're losing 20%. It's that fast. It is that fast that you will lose 20% of your itemized deductions, and it actually creeps up to more than that. So this is part of the new tax law change. Again, watching these threshold amounts are going to be really important here at the end of the year. Next lovely level for the tax law change is that your medical expenses We used to have to get over 7.5% of our total income to deduct $1 of medical. Now it's 10%. Now it's 10%. If you're 65, you still get 7.5 for another 2 years. These are still high thresholds unless your income is dropping. So I actually see a lot of people that are retired that get medical expenses because their income has dropped. But typically, my clients, when they're in the working stages of life, we can't get over the 10% of income. Okay, why the government has decided it's going to be like that is really baffling. Why medical expenses are, but it has been here a long time, and they're not changing their minds. Now, that's not to say that you can't have a health savings account, and we'll talk about that later. The personal exemption, again, we're looking at these dollar thresholds. When you hit $400,000 individual, $450 married, you no longer get a deduction because you're a human being that lives and breathes. Okay, you don't get one for yourself. You don't get one for your spouse. You don't get one for any child that you still have as a dependent. They're just gone once you hit those thresholds. Again, January 1st tax law change. Now, in California, we had this in 2012. This isn't 2013. It was last year. We put into California Prop 30. It was retroactive. We passed it in November of 2012. It was retroactive to January 1st, 2012. And it said, if your income exceeds $600,000, doesn't matter if you're married or single, $600,000. I'm sorry, it's $300,000 if you're single, $600,000 if you're married. It does matter. Half of that's for single. You have new increased rates. So for every dollar over $600,000, you're going up to 10.3 because the top rate in California is 9.3 on individuals. So you go up 1 percentage point to 10.3 on everything over $600,000. When you get to $700,000, it's 2% of everything over $700,000. And if you get to $800,000, it's at 3% on $800,000 to $1 million. Once you hit $1 million, you have another 2.5. So when you hit $1 million, you're at 5.5% increase on top of the 9.3. So your California tax can be very high at the $1 million level. So I have some clients that are here. You say, well, whoever gets there, well, there are people. They actually are people. All right. So what can we do? What's some more ideas here? Year-end purchases. We still have the ability to deduct up to $500,000 in new purchases of equipment and improvements up through December 31, as long as you don't exceed $2 million in all improvements and purchases for the year. For instance, if you own your own building for your business and you're redoing it, as long as all the improvements, et cetera, don't exceed $2 million, we can write off $500,000 of those things, boom, first year. Okay. In 2014, it goes to $25,000. That's the way it stands right now, unless Congress and the President make this go further. So just be aware that we're still looming there to go back to $25,000. $25,000 is where California has always been, by the way. California never went for these bigger amounts, so we've always had this adjustment between California and federal. Cars, so we want to talk about cars. If you buy, I'm missing a zero there. If you buy an SUV where the weight is over 6,000, not 600, 6,000 pounds, you could deduct $25,000 in the first year as a bonus, okay? But that's if you have 100% business use. It goes down if you don't have 100% business use. I don't know anyone that has 100% business use unless it's a truck used for a handyman or construction, okay? Or you use a truck for the business to run around and you've got a Mercedes for the evenings and weekends, okay? But it's very hard to get 100%. If it's under 600,000 pounds, you actually get $8,000 bonus in the first year for buying a car, and then you get some depreciation on top of that. It brings you up to about $11,500 if you're 100% business use for the first year of buying a car. So it is great. By the way, a lot of people ask, should I buy or lease? For tax only, and I'm talking tax only, leases are much better. The adjustment to lease, which is renting a car, the adjustment for that is very low compared to being able to take all the lease payments, okay? So for tax, it's much better. On a financial point, I will tell you, I think leases are just a disaster, and I don't recommend them, but for taxes, they actually come out better. All right, so the next item is 50% bonus depreciation on new assets. You have to buy something new, not new, then you don't get this, and on improvements. 50%. So whatever it is, you deduct 50%, and then you get to deduct even more because whatever's left we get depreciation on. That goes away in 2014. No bonus depreciation going forward. Okay, so just realize this is the last year to write off a whole lot of stuff up front. What else can we do? Well, I mentioned it before. Monitor your income in the last couple of months here, because if you're close to those thresholds, you want to keep it under those thresholds. You want to keep your gains and interest down because of the new Medicare taxes. So you want to look at that. Again, accelerate expenses. You know, if you have an ability to write off a lot of stuff, even if you put it on credit cards, putting things on credit cards is a deduction for 2013, even though you paid in 2014. So try and accelerate expenses if 2013 is an issue or you're close to those thresholds, or if 2014 is going to be a higher year, we might want to move expenses to 14. We'd have to talk about that. Business promotion versus charitable contributions. A lot of people get this confused. If you give money, donate things to a charity, and they thank you with your business name in a public way, like in the program for the event or on their website or in something, even the follow-up to it, or in a picture that they have, that's business promotion. It's a business expense. We'd much rather have business expenses than charitable contributions because, as we talked earlier, charitable contributions are being reduced if your income hits to certain levels. So the more that you can get a thank you in your business name, the more you get a better deduction rather than a charitable contribution. Okay? All right, so out-of-pocket expenses, reimburse yourself from the corporation. Absolutely. As business owners, we're out there, we pick up things, we just don't think about it. We pay cash because we just took some cash out, or we put it on a personal credit card because we didn't have the business one. Make sure the business pays you back so that we get those expenses. It can be a couple $1,000s, so you want to scour for those things and make sure all the receipts for business things you get reimbursed from at the corporation. If it was a notebook, if it was buying pencils, then it's supplies, and pretty much everything that we do would be supplies. You say, we increase supplies, and you write a check to yourself. Okay, that's how it works. Home office deduction, new rules. If your business is an S corporation, you must get reimbursed by a check from your corporation account for the home office deduction. We used to calculate it and throw it on as an extra deduction for the tax return. No longer. It cannot just be a tax calculation we throw on as an extra expense. You must calculate it. You must have a check written out to you for reimbursement from the business for use of your home as an office. Okay? If you're my client, we're calculating these things. If you don't know how to do it, your accountant or we can help you with that. Retirement plans are more important than ever. Remember what I said, if your income goes over that $400,000 if you're single, $450,000 if you're married, you're into 50% tax brackets. You're into 50% tax brackets for income tax. That's not to say the Medicare and the Social Security and the other stuff you've already had withheld on having to have wages. We're talking just the income tax. Defer, defer, defer. You need to put money in retirement plans. You are not going to be at these rates when you retire. So you need to really strongly consider where your plans are and how to maximize them, maybe even changing them up. Okay, next slide. More year-end planning of what to do. Buy the equipment. We've talked about that. $500,000 write-off this year goes to $25,000 next year. Do your children help in the business, and do you pay them? You should. And they really need to work in the business. So they need to do something. They need to be of an age that they can do something, but you should pay them. And your accountants, your CPA, or if you're my client, we talk about this, what they can do and how much you could pay them. If they're very, very young, there are still ways that you could pay them for various things, and we go through that. But, strongly suggest it, because if they're really doing something in your practice, you can move some of the profit to them and pay them salary, set their lower rates. They actually worked for it. You can put it in a Roth or put it into a retirement plan for them. So want to consider that. All right. If your income is $72,000 or less and you're married, or $36,000 and you're single, you have a zero capital gains rate. And here what I'm talking about is my clients really typically are not in these places, but your kids could be. Your kids could be. So you could give appreciated stock, gift it to your children. They could sell it, pay no tax on selling that stock, and use it for college education. Okay? So think about this. There is no zero capital gains rate for California. Just realize we don't have that in California, but federal's the bigger tax, and you would have zero capital gains rate in California, in the IRS. Okay, California would still tax you, so it depends on how much that is, and we can calculate it. But remember, the highest rate, if these are the amounts that you have, would probably be about 6% California tax. It's not huge. Okay. The next item, capital gains of stock and asset sales if you have losses. A lot of people have losses from 2008 and 2009 still. I have a client that's got $500,000 plus in losses from those years when our stock just took a dive. A lot of people decide to go to cash and still have a ton of losses out there to use. So we can absorb gains when the markets come back. If you were lucky enough to have that Yahoo stock that went through the roof, fabulous, you got it. Or even the Twitter. If you got the Twitter stock at 26 a share and it sold right out of the gate at 45, this is where we're talking about those losses would come in handy. So, all right, the last one. Donating stock. If you do have appreciated stock and you want to make the most out of it and you don't need it yourself, okay, donate the appreciated stock to charity. The charity will be able to give you a deduction for the fair market value. Whatever the total price of that stock is a charitable contribution for you. You don't have to worry about capital gains on it. So you get a huge charitable contribution. They get to sell the stock. They get to keep all the money because charities, if they're nonprofit, don't have to pay that gain. So it's a great win. And you get out from underneath investment Medicare tax if you had sold it yourself. So if you don't need it, it's a great way to get a really great tax deduction for it. Next thing, what to do on the next slide. Fund the retirement plan to the maximum. I see people not funding 401ks to the maximum. It's $17,500 this year. And it goes up if you have the catch-up of another $5,000. So take the maximum. Fund an HSA. I mentioned this earlier. It's a health savings account. A health savings account can only be set up if you have a health insurance program, a plan, that is a qualified, high-deductible insurance plan for a health savings account. It has to be what's called a qualified, high-deductible insurance plan, health insurance plan for a health savings account. I've got a client that has a $5,000 deductible health insurance policy, and it is not qualified to have a health savings account as part of it. So you must make sure of that. This year, it's a $12,000 tax deduction for a family. Okay, and when you take the money out, because it's to pay for medical expenses, you don't pay any tax on taking that money out. It is the only thing we have where you can deduct it and then take that money out tax-free. We get a tax deduction, and you don't pay tax when you get it back. It is slick if you can do it. With the all changing of the health insurance programs, I'm not sure how many still have this available. I hope they still do. So, children over 24 with stock, again, there's zero capital gains rate, and the reason I put children over 24 is because we get them out from underneath kiddie tax and some other things where they would actually get hit with your rate. So we do have to be particular about the age of the child. It could even be over 19. It depends on whether they're in college or not. Okay? Credit card for last-minute expenses. Absolutely. When you charge it is when we get the deduction, not when you pay it. So those are some of the to-dos. Think about those things, some things that you might want to do. But overall, accelerate expenses into 2013. Watch your income in December. If you're about to get a bonus, can you defer that into 2014? If you're going to get paid by an insurance company or by one of your clients or patients, can you defer that into 2014? You know, that's when you do accelerate expenses, defer income, because the rates are just huge, especially if you're at those income levels that we talked about. Well, I'm going to change gears for a moment here because there's something coming January 1st, 2014 that we need to be aware of. which is a tax law change that just came into place this year regarding repairs and supplies. Repairs, when I talk about it, is for your business or rental properties, and supplies in your business. So here's how it works. Beginning January 1st, 2014, if you have supplies and every single item is under $200 and you're going to use it up in 12 months, you get to write it off, no problem whatsoever. But if you have a single item on your supply bill that's $200 or more, you cannot deduct that as a supply expense. The government says you've got to set it up as a new asset that you bought and take it over the life of that asset, which is from 5 to 39 years. For supplies, it would be 5 years. It is insane. All I can tell you, I agree it's insane. Can you imagine how many $200 items we would be clogging up that list? Now, the good news is, remember, we've still got that Section 179 write-off of stuff early, and even with $25,000 beginning in 2014, we probably get to write it off anyway. But it's insane what they're talking about here. Think of large companies, how this will impact them, including the small companies. It's crazy. So again, if you're going to use it up in 12 months, we probably don't need to worry about it, but this is the rule. Next thing, it's a simplified method for small businesses. That's everybody under $10 million in total assets, which is my whole client base, and hopefully everyone listening. If you have rental properties or your business, and you have repairs and maintenance, if any single item is $500 or less, and you're going to replace that within 10 years, whatever that item is, write it off. It's repairs and maintenance. You cannot break up a large repair and improvement project so that every single thing is $500 or less. If you've got a large repair or improvement project, that's what it is. It's one project. It's one amount. We can't take little things out of it. If you have items that are $500 or more when you're doing repairs and you're not going to replace that in a 10-year period, we have to set it up and write it over 5 to 39 years, depending on what it is. Yep, I agree. This is insane. These are final. This isn't like proposed. This isn't like they're thinking about them. This is it. This is their final say on it. It's been 2 years in the coming. This is their final say. So the saving grace is we hope if you're spending that kind of money, you're going to do something to repair it again in 10 years. So we just still write it off. But it depends on what it is. Improvements. It's the same thing. So improvements, the definition is, if these are costs to improve a piece of property and it's going to improve the life of it, it's going to better the life of it, or it's going to restore it to what it was, we have to write it off over time. We cannot just write it off at one time. Okay? So if it makes it the same as brand new, or it makes it better than it ever was from the beginning, we have to take it over time. If it's simply a repair, it's a repair, but we got that $500 item. Okay, our next one. So that was 2014 coming. Again, I think our saving grace is Section 179, where we can write up to $500,000 off this year, but really we're moving into 14 where we still have $25,000. I think that's going to capture a lot of that. Again, with repairs, we typically repair a thing over and over within a 10-year period of time. I think that's the saving grace, but it will be looking at all your repairs. We can't just stick them in a repairs expense account anymore. We just can't. So now on the next slide, I'm going back. Let's think back to 2013 again. I want to talk about 2 items in 2013 that are here. They're not actually things that are going to save you tax. I just want to make you aware of them. If you're a dentist or a doctor on this call, there's something called the New Physicians Payment Sunshine Act. Don't you love that? New Physicians Payment Sunshine Act. What this is the government's now requiring your vendors, if they give you gift cards or little thank yous of $10 or more, they now have to report it to the government that they gave you those things. So if they gave you a $10 gift card for thank you for your business, or in some cases, some of these bigger vendors like Novo Nordisk or some of these bigger companies, they give bigger gifts for spending a lot of money with them. In the past, I've heard about, vacations. They're giving vacations away to the doctors for buying stuff from them. It's now going to go on a 1099. Many of you don't see these things because your managers, thank you very much, take those. Well, now they're going to be a 1099 reported to you, so you better make sure you know how much is actually getting done in your office. There's also I transposed the numbers, a 2.3% excise tax, not 3.2, on new dental and medical equipment, and that's been 2013 and going forward. I had been reading on this and keep reading on it that we were hopeful that by the end of the year that was going to be repealed because people understood that was really causing a problem, but it is not being repealed. It still is sticking. So I want to let you know that's still there if you hadn't heard that. So that takes us through 2013 tax law changes, year-end tax planning, what's coming up in 14. If you haven't heard about those things, I wanted to bring them to your attention. If you're wondering if those things are helping, you're my client, certainly give a caller here, and we'll talk about them. I'm doing year-end planning with my clients now, so there would be a great time to have these conversations if we haven't already. If you're working with someone else, you might want to make sure that you are thinking about these as year-end approaches. So my next slide is how to fund college costs for children. I hear this a lot from my clients is, what can we do about these costs for college? Is there any way that I can use pre-tax dollars to pay for this? Am I just going to pay tax and then pay this out? What can we do? So my first slide is just going over some of the costs. An average cost of a private university now is $45,000 a year, and we're just talking tuition. And they've come to this magic number. All of them have come to this magic number. I don't care if it's Biola, USC, Harvard, Dartmouth. I don't care which one it is. They're all at this magic number. When you add housing and food, et cetera, it's $60,000 to $65,000 a year. Okay, it's an incredible process, an incredible number to think about. A 4-year state school is now $12,000, and with food and housing, it's over $30,000. So even that is becoming expensive. So, I've got my clients who say, I've got to fill out this FAFSA form, which is the free application for federal student aid. It is what every college makes you fill out if you want to play at all. If you think there's any money or any hope of money, you got to fill out this form. It's electronic. It asks about the kid's income, about your income, and you have to fill it out just in case your child might get some free money, like a scholarship or anything, okay? Well, I can just tell you right now, if your income's $200,000 or higher, you will not get any money. But your child might get a scholarship, so you still have to go through the hoops. I had a client recently that had to fill it out, and their child's not going to go to college until fall of 2014. They're filling it out now for next year. And I said, that is just incredible. And he said, I know I'm not going to get any money. Well, what the school was doing was looking to say, if we don't have to give you money, then we have that money available for someone else. So we need to know what your statistics are so we can tell the school we still have money and scholarships for other people. We don't need to worry about giving money to these people. So it's interesting the games that they play. If you're looking for where there's free money, there is a website called collegeboard.com, okay, collegeboard.com, and they are telling us that there is over $11 billion with a B dollars available for private scholarships. We're talking about private companies who have scholarships for students. Okay, so go to the next start. Here's some additional search engines for where this is. FastWeb, CapEx, Scholarship.com. These are places you can go to see what corporations have free money for students. Now, it comes with catches of what you have to write up and what the qualifications are, but there's money. Parents, there is money out there. I can tell you as a CPA, the California Society of CPAs, we give money to students that are in the accounting programs from a 2-year local community colleges to the first 2 years of a 4-year, to the next 2 years of a 4-year, to a master's program and a PhD in accounting. We have free money out there for students. And I'll tell you, we have a hard time giving it away because students don't apply. They don't think that they'll get teachers to give them any kind of a recommendation letter. They're too shy to ask. So parents, there's money out there. Make sure your kids are looking for it. So, for instance, Coca-Cola. Coca-Cola gives between $10,000 and $20,000 in scholarships every semester. Every semester. There's a lot of people vying for those, and there's a lot of qualifications. But you need to do it. The Elks Club, $50,000. These are really competitive, but you need to check it out. You need to check it out. Plus, there's churches, there's other organizations that also give out money. I wanted to bring this up because a lot of people don't know. A lot of people don't know. So the next slide, college funding. A lot of people ask, well, what do you think of a 529 plan? And I think there's absolutely nothing wrong with a 529 plan. The idea is to put it in there early enough so that it can grow. The whole idea of a 529 plan is you put the money in once and you can do up to $70,000 front load right up at the very beginning and let that money grow until your child is at college age. So we know if you put it in early, that multiple of that $70,000 by the time they get to 18 and go to college can be huge. And there's no way that you would have to ever pay for their college. It is not a tax deduction, but the appreciation is never taxed as long as you use it for education, and you can change the beneficiary every year. Okay, so depending on how many kids you have and how much you need to use, you can move the beneficiary. Okay. Now, the one thing about the 529 plan is it's really meant for grandparents. The reason that I say for grandparents is because when you fill out that FAFSA form, the free application for federal student aid, you have to put this down as your asset, the parent. So if it's a grandparent, they don't. But the child and the parent have to disclose their income and their assets, and this would be an asset of the parent. We really like the grandparents to do these things. The other is when you use the money, it must go directly to the school. If it comes to you or your child, it will be deemed a distribution and could be taxable, especially if it comes to you. It will be taxable. The beneficiary is your child or the school. So be very careful when you take it out. All right, so the next one. Are your college-bound children social media savvy and mature? Okay, I put two things in there. Are they social media savvy? I think 6-year-olds are social media savvy. My Lord, it's incredible. The other is I put mature. And the reason I put mature is because teenagers have an attention span of a gnat. And what I'm going to suggest to you is something that needs both those, social media savvy and mature. Do they know what a website is? Could they help you put one together? Do they know how to tweet? Do they know how to LinkedIn, Facebook, all the things that you want to do to promote business and get information out there? Not personal, we're talking business. But the mature part means they have to focus, they have to be responsible to get some things done and actually follow through and do it. There is an ability to set up a business like an LLC and have your children be the owners of the LLC and be your social marketing, media, website consultants. But they have to do things. They actually have to do this. They have to put in tweets. They have to be responsible, and you have to put them on a schedule to do things. And there is then a way to pay them a fairly good amount of money to do that because these social media companies charge a lot to do this. So you have to meet these two criteria. Can they sit still? Can they be responsible and mature that they will actually do some things because they have to? So I'm putting it out there. I'm not saying you can just pay them money, but there is a new way to do this. Well, that's what I have for 2013 year-end tax planning and for college planning. So, Jeff, I'm going to throw it back to you to see if we have anybody that wants to ask questions.
Okay, the lines are open. If you do have a question and you are on the phone line, you can go ahead and just ask that question. Let me check here. Had a dentist. Hi, Monica. Looking forward to the presentation. Have to leave in about 30 minutes for another meeting, but wanted to learn real quick, so it looks like that person came and left. But that's it. No questions other than that comment.
Does everyone know how to get to the phone lines? We should tell them one more time if they're there.
Well, if you're listening on the phone, all you need to do is just go ahead and talk. The lines are open. If you're on the webcast, there's a question box in the bottom left-hand corner. You just type your question into that box, hit the submit button, and that question will come through. And I can check here. I think that's it, Monica. Okay.
Well, again, thanks, everybody, for taking a few minutes before Thanksgiving to listen, and hopefully I spurred on some things for you. Have a wonderful Thanksgiving and happy holidays to everyone. Jeff, the same to you. Thank you so much for taking time to help me with this tonight. I know that you're a busy guy getting ready for Thanksgiving, but have a wonderful Thanksgiving and holidays yourself. Thanks so much.
Thanks, Monica. I appreciate it. We'll see you soon. Bye-bye, everybody.